Welcome to our discussion on principles of economics, and we were discussing about money and monetary system, which is one of the most important topics in macroeconomics. So, if you recall, in this particular module, so far we were discussing about the monetary system consisting of financial markets and then financial institutions like banks and mutual funds. And when we talk about financial institution, we learn that the role of these financial institutions, particularly banks, is to match the savers fund with the investors requirement. For example, if I want to save my money, I will go to the bank and I will deposit. Bank will give me some return in terms of rate of interest, and if some investors, a household or a firm, they require fund, they will also go to the bank and they will borrow. Bank will give them fund, and in return they will charge a higher rate of interest than what the bank is supposed to pay to the savers. In that way, bank will also make some profit. So, that means the savers and the investors, they are not meeting directly, but their requirements are fulfilled through this financial institution like bank. That is one role that we have discussed earlier. Now, today what we are going to discuss is the another important role of bank in terms of money supply. How does bank can actually influence money supply? Now, to connect this bank's function with money supply, see, we told first of all, total money supply in an economy is basically consisting of demand deposits and the currency held by the public. When we go to bank, we deposit our money, and that deposit is counted as one component of money supply. Since money is deposited in bank, bank's behavior about what bank is going to do with the deposit, that will determine the money supply in the economy. So, bank can actually do two things. First of all, let us assume that whatever money we deposit in bank, bank is going to keep the entire money deposited by the public in the vault, and their bank is not lending any money out. So, in that case, bank's role is only to provide some amount of some safe place for public to deposit their money. And in that case, what is, let us say I deposit 100 rupee to the bank, and bank keeps that entire 100 rupees in their vault. So, in that case, what is the total money supply? Is 100 only, because there is no cash in my hand, there is no currency held by the public. So, only one component of money supply, that is demand deposit, is there in the bank. And since bank is holding the entire money in their vault, there is no additional money created. In this case, total money supply is 100 rupees. When bank is behaving in this way, instead of using that deposit to give loan to others, bank is basically keeping the entire money in the vault. That is one scenario that we can assume. In that case, bank is not creating any money. But now let us assume that when I deposit 100 rupees in bank, instead of keeping the entire money idle in their vault, bank can also think that let us keep some amount of money in our holding as deposit, rest we can actually lend it to others and charge interest rate on that, and thereby we can make some profit. Why to keep the entire money in our vault idle? Let us say that bank is keeping 10 rupees as reserve and 90 they are giving loan. So, in that case, when money is coming out of the bank, either I can hold the money 90 with me, or I can buy something and that person will go back and deposit that money to another bank. Then what is the money supply? Initial deposit 100 plus another 90 rupees deposit to some other bank. So, total money supply has now become 190. Look at the fantastic role that the bank is playing. The moment bank tries to give some amount of their deposit as loan, money supply increases. And the amount of money that the bank is keeping as reserves, this is called reserve requirement ratio. When bank is keeping 10 rupees, it is 10%. Okay? 10% of the total deposit is kept as the reserve requirement ratio, rest is given as loan. So, these are the two alternative ways by which bank can actually work. When the bank is keeping the entire money as reserve, that means in that case reserve requirement ratio is 100%. Bank is not creating any additional money, total money supply is only 100 rupees. Next, we assume a fractional reserve requirement ratio which will create additional money. Let us now try to understand this the example. So, banks can actually influence the quantity of demand deposits in the economy and money supply. Okay. So, reserves are basically the deposits that bank have received, but have not loaned out. So, when I go and deposit my money, that is the reserves. And in a fractional reserve banking system, as I said, banks hold a fraction of the money deposited as reserve and lend out the rest. Okay. The example what I have given, fractional means 10% as reserve requirement ratio, 90% as loan. So, the reserve ratio is the fraction of deposit that banks hold as reserves. So, earlier example, that is 10% out of 100, 10 rupees kept as deposits and remaining the bank is giving as loan. So, when a bank makes a loan from its reserves, the money supply increases. How? The money supply affected by the amount deposited in the bank and the amount that bank's loan, because the total money supply is the summation of deposit plus the currency hold. So, deposits into the bank are recorded as both assets and liabilities. So, I will show you with example why it is called asset, because with that deposits bank can actually give loan and generate income. So, that is why it is called as asset, because that generates future income for the bank. Why it is also treated as liability? Because when I deposit 100 rupees to bank, it is bank's liability to me. I can anytime come back to the bank and ask that I will now withdraw, and bank needs to pay me that with interest. So, that is why that 100 rupees act as a liability of the bank to the depositor, and then that 100 rupees is an asset, because bank can use that money for giving loan to others and generate income. That is why it is treated as asset. The fraction of the deposit that bank has to keep as reserve is called reserve requirement ratio, and loan becomes an asset to the bank. 10 rupees I am keeping and 90 rupees I am giving loan. So, that means 90 rupees only will generate future income for me, not that 10 rupees. So, that is why it is now becoming asset as 90. So, now we will see one T account, hypothetical account. So, bank accept deposits and then keeps a portion of this as reserve, which is called reserve requirement ratio, and lends out the rest. We assume that 10% is the reserve requirement ratio. Look at this. Let us assume that the First National Bank So, I have $100 or 100 rupees. I go to this First National Bank and I deposit. So, deposit is 100 rupees and banks, as I said, bank's liability is 100 rupees. Okay? And then bank, why this is 100 rupees? Because that 100 rupee bank has to pay to the depositor at any point of time. If you go to the left side, then reserves is also has two component. Reserve as left side is asset, that is also 100 rupees. So, that asset and liability can actually match. All the time my assets should be equals to liability. Now, within that assets, 10 rupees as reserves and 90 rupees actually I am giving loan. So, total asset is 900, total liability is also 100. So, this is called, since this is balance, this is called a bank's account balance. Okay? Balance sheet, actually sometimes it is also known as balance sheet. This particular T account is called balance sheet. Why this is called balance sheet? Because asset is always matching with the liability. So, when one bank loans money, that money is generally deposits into another bank, is not it? Let us say that I get the money from the bank. What I will do with that money? I will also buy something. Let us say I buy a shirt, then the shirt owner will get that money and that shirt owner will deposit that to some other bank. So, one bank's loan is again deposited into another bank, and this creates money deposits and more reserves to be lent out. And when bank makes a loan from its reserves, the money supply increases. Very simple to understand. Okay? Because the loan what I take, I will also use it for some purposes, and then next person or next to next person will again deposit that money into some other bank, and that is how the demand deposits increases, money supply increases. Now, the question is, in this process, how much money is eventually created in the economy? Look at this. So, how much money would be ultimately created, that would be determined by a money multiplier. So, you can take a this hypothetical example. I deposit 100 rupees to the First National Bank, then the First National Bank keeps 10 rupees, because the reserve requirement ratio is 10%, we assume. Remaining 90 is given as loan, and that remaining 90 will come to me when I take loan or some other person. That person will again, let us say, deposit it to the Second National Bank. So, Second National Bank will keep again 10%, 9 rupees, and give 81 rupees as loan. So, that means in this process how the money supply is increasing? 100 plus 90 plus 81 plus again Third National Bank will create 72. So, this is an infinite process. 100 plus 90, 100 is the deposit of the First National Bank, 90 is the deposit of the Second National Bank, 81 is the deposit of the third national bank, 72 is the deposit of the fourth national bank. So, total money supply then is the summation of an infinite series, which is 100 plus 90 plus 81 plus 72 and dot dot. It will go up to infinite. And what is the summation of this? Summation of this infinite series is basically 1000. So, that means when the reserve requirement ratio is 10%, money multiplier is the reciprocal of the reserve requirement ratio. So, if it is 10% means 1 by 10, that is the reserve requirement ratio, and money multiplier becomes 10. So, if the initial demand deposit is 100, total money supply would be 100 multiplied by 10 equals to 1000. Okay. So, depending on the reserve requirement ratio, the money supply will increase. Higher the reserve requirement ratio, lower would be the loan and lower would be the money supply. For example, instead of 10%, if it is 20% now, okay, 20% you have to keep in your account, then remaining 80 only you will be able to give loan, total money supply will decrease. If it is 25, that means 1 by 25%, that means 1/5. So, you have to, what is money multiplier? Only 5. So, total money supply would be 100 into 25% means 1 by 4, total money supply would be 400. If you keep on increasing, if it is 50%, then money supply would be 100 into 2, 200. If it is 100%, then money multiplier is 1 and total money supply would be 100 into 1 equals to 100. No additional money is created when it is 100% reserve. I already told you in the beginning, because 100% reserve requirement ratio means actually bank is keeping the entire money in their vault, no loan, no deposit in the second or third or fourth bank. That is how it works. Look at this example. First National Bank receives 100 as deposit. At the left side, it keeps 10 rupees or $10 as reserves, $90 is used as loan. So, total asset is 100 rupees. Now, look at this arrow. This arrow is showing this 90 is actually becoming the deposit of the second national bank. That is why if you add these two, first national bank 100 deposit, second national bank 90 deposit. So, total money supply is 190. If you create another bank or third national bank, this arrow will go extended to 81. So, 100 plus 90 plus 81. Another fourth national bank means 100 plus 90 plus 81 plus 72. Like that, it will proceed. The more bank you create, the more deposits will come. Every bank will keep 10% of their deposit as reserve requirement ratio, remaining will be used as loan, and that is how money supply will increase. So, total money supply is 190 when there are only 2, but this process will continue, right. So, money multiplier then is the reciprocal of the reserve requirement ratio 1 by R. If R is the reserve requirement ratio, then money multiplier is 1 by R. So, with the increase in requirement, reserve requirement, let us say R equals to 20% on 1 by 5, then money multiplier is 5. Okay. So, the Fed, or basically the Reserve Bank of India in Indian context, as I said, they have 3 tools in their monetary toolbox to control money supply. One is open market operation. And what is open market operation? Either buying or selling government bonds. If the Reserve Bank of India wants to increase money supply, okay, then Reserve Bank of India will, what they will do? They will sell, they will buy the bond. When they buy, they have to buy it against money, money supply will increase. If they wants to suck money from the economy, if they want to reduce, then they will sell bond, so that people will buy bond with money, money will go flow from public to RBI. This is how open market operation works. Then changing reserve requirement ratio, as I said, because money multiplier is the reciprocal of reserve requirement ratio. We saw when it is 10%, then the total money supply is 1000. When it has become 20% or 25%, then it has become 500 or 400. That also we have understood. Now, changing the discount rate or interest rate, this is something we need to understand. What will happen when the bank is increasing or reducing the interest rate? Now, interest rate, sometimes economists they call interest rate is the price of money. Why it is the price of money? Because if I keep my if I keep money with me, if I keep all my cash in my pocket, then actually I am sacrificing interest. That is why I say that what is the price that you are paying by holding cash with you? Basically the foregone interest. Okay. So, when the bank is actually increasing the interest rate, then what will happen? People have very less incentive to hold cash in their pocket. So, money supply will decrease. So, there is an inverse relationship between interest rate and the money supply. Let us say RBI wants to increase money supply. So, when you are increasing money supply, someone has to hold the money, right? So, how I will hold more money? When RBI has injected more, then I have to hold, and how can I hold? Price of money should go down. That means interest rate should go down, then only I have an incentive to hold the money. Otherwise, I have no, if the interest rate is so high, money will flow from public to the bank, money supply will go down. Okay. So, there is an inverse relationship between discount rate, that means interest rate, with the money supply. So, by changing these three, RBI or Fed in the US context can actually change the money supply. Okay. So, the Fed or Reserve Bank conducts open market operation when it buys government bonds or sells government bonds. When they wants to increase money supply, what they will do? They will buy bonds. When they are buying bonds, they will have to buy against money, money supply will increase, money will flow from RBI to public. When they want to reduce the money supply, what they will do? They will sell bond, money will flow from public to RBI. Okay. And reserve requirement ratio, as I said, that RBI is basically the banker's bank. So, RBI from time to time they will instruct the bank about the reserve requirement ratio. So, if they want to increase the money supply, they will reduce the reserve requirement ratio. If they want to reduce the money supply, they will increase the reserve requirement ratio. So, obviously, when the reserve requirement ratio is higher, less money is used for loan purpose, money supply will go down. Okay. And reserve requirement ratio, it is governed and regulated by the central bank. Okay. Reserve requirement ratio, as I said, is the amount percentage in percentage of a bank's total reserves that may not be loaned out. increasing the reserve requirement will reduce the money supply. Decreasing the reserve requirement will increase the money supply. The logic is very simple. More the reserve requirement ratio, less money available for loan, and that is why less money supply. Okay, and that is why we saw that from 10%, if you keep on increasing the reserve requirement ratio, since money multiplier is the reciprocal of that, you will get lower and lower money multiplier, and your money supply will also reduce. In the extreme case, when it is 100%, reserve requirement ratio means your money supply is only 100, that initial deposit. Okay. And changing the interest rate, increasing the interest rate, as I said, will reduce money supply. Okay. When interest rate goes higher, then I have very high price to pay if I hold cash. Cash will go to the bank, money supply will reduce. Reducing the money supply means I have now incentive to hold extra cash with me, money supply will increase. So, there is an inverse relationship between interest rate and the money supply. Interest rate is basically the price of money. Like any other market, when the price is higher, supply is demand and supply is less. Price is low means demand and supply would be more. So, that is how we can say that inverse relationship between price and quantity. Here also inverse relationship between interest rate and money supply, because interest rate is considered as indirectly the price of money. Now, what is some of the problems that Reserve Bank of India may face in the money supply? See, there are specifically two things. RBI can control how much money a particular bank will keep as deposits, as reserves, by controlling the reserve requirement ratio. But RBI has no control on how much money the household will hold as deposits in bank. I can hold the cash with me, or I can deposit it with the bank. Okay? So, that is up to me. There is a problem. Indirectly I can change by rate of interest, but there is no direct control. Secondly, RBI can say that okay, 10% is the minimum reserve requirement ratio, 90 you are allowed to give loan, but whether a particular bank will give 90, entire 90 for loan or not, that is up to the bank. So, RBI has no control on this 90 rupees. They can use the entire 90 for loan, or they can keep additional money in their vault more than the minimum reserve requirement ratio and use, let us say, 70 rupees as loan. So, these are the two things that is beyond the RBI's control. Firstly, RBI cannot decide how much money the households will choose to hold as deposits in the bank and how much they will hold as cash or currency in their pocket. Indirectly they have a control with interest rate, but no direct control. Secondly, how much money the bank will use for loan, that is also beyond RBI's control. RBI cannot decide everything. Minimum I can keep 10 rupees, but rest what I will do? Out of 90 rupees, whether I will use entire 90 or 80 or 70 or 50 or that I do not know. Okay? So, that is why these two things are beyond RBI's control. So, in summary then, what we understood, the term money refers to assets that people regularly use to buy goods and services. Please keep in mind, even though money refers to asset, not all assets are treated as money. because that asset has to be liquid. That means that asset has to be easily converted, it should be convertible into the medium of exchange. For example, gold can be treated as money because gold can be converted as money easily, but not my 2 BHK apartment or a stocks, which cannot be liquidated easily. So, that is why the assets that we use for regular day to day exchange, that only we call as money, like the currency like gold or silver. Okay. And then money basically serves three important purposes: medium of exchange, that is the common purpose; a unit of account, that means, or an yardstick. What is the price of this shirt? 500 rupees. What is the price of a pen? 20 rupees. So, without this money, then how I am going to quote the price of a pen or a shirt? If the shirt costs 500 rupees and if the pen is 10 rupees, then probably I have to say that this shirt costs 50 pence or this pen costs 1/5 of this shirt. In that way, that looks very absurd. So, that is why money acts as a unit of account or yardstick, and it can act as a store value. When I am keeping my deposits into bank, then that is what is a store value. Then there are two types of money: commodity money with intrinsic value, we discussed, like gold, silver. We also discussed about even cigarettes used to be considered as money during the Second World War. Another money is called fiat money, which does not have any intrinsic value, but still people are accepting it because of the fiat. Fiat means the decree, the promise that RBI gives, that I promise to pay the bearer the sum of 10, 20, 200, 500 rupees. That is why that is called fiat money. And the Reserve Bank of India is the central bank in India. Federal Reserve is the central bank in the United States, and the Reserve Bank of India controls money supply through open market operation and by changing reserve requirement ratio and the interest rate. We have already discussed how money supply can be increased and decreased through open market operation, by selling and buying bonds, by changing the reserve requirement ratio, because the money multiplier, which is the reciprocal of the reserve requirement ratio, that changes through this, and discount rate or interest rate. Higher the interest rate, lower would be the money supply; lower the interest rate, higher would be the money supply. Inverse relationship. And when banks loan out their deposits, they increase money supply in the economy. We understood by money multiplier. Even though central bank can control money supply to some extent by changing reserve requirement ratio or by changing the interest rate, they have very less control on the households, how much deposit they will make in the bank, and also how much money the bank will use for loan purpose. So, that is why RBI does not have perfect control on money supply, some kind of imperfect control, we can say that. With this, we are closing our discussion today. Thank you.